Bismillahirrahmanirrahim. This is our sixth week, and in this week we'll be starting with acquisition valuation. As when we talk about valuation, and if we are primarily talking about valuation of an acquisition, it actually involves the utilization of different analytical tools or financial valuation models to determine a range of possible prices to pay for an acquisition candidate. That means the company you are planning to acquire. So for that company you have to identify different valuation aspects. So there are many ways to value a business, which can yield varying result depending upon the basis of each valuation method. Some methods assume a valuation based on assumption that a business will be sold off at bankruptcy price, while other methods focus on inherent value of intellectual property and strength of a company's brand, which can lead much higher valuation. So there are a variety of tools which you can utilize in order to value an acquisition, because this acquisition would serve as your future business, and you have to amalgamate that business into your own business. So there might be certain synergetic, controlling, and any other aspects which you want to pursue or which you want to achieve from that acquisition. So based upon your intention, based upon the future expectation from that acquisition, you will be devising certain tools in order to identify that what would be the probable impact of that acquisition into your future business operations. Now, before discussing the valuation of acquisition, it's very important to briefly discuss the process of acquisition. As we are discussing this topic from the book of Corporate Finance, Theory and Practice by Ashwin Damodaran. It's actually chapter number 25 of this book, and this book is about acquisition and takeover. So in that book, the Damodaran suggests that there are basically two type of acquisition. That one is your friendly acquisition, and second one is your hostile event or acquisition. Firstly, the friendly acquisition is the process, or is the arrangement in which the manager of the target firm, or the firm which is being the prospect, and the firm which the acquiring firm is targeting, is actually the manager of that firms are very much welcoming the acquisition, and in some cases they want to seek it out. But in the case of a hostile acquisition, the target firm's management does not want to be acquired. So the acquiring firm offers the price higher than the target firm's market price prior to the acquisition, and invites the shareholders in the target firm to tender their shares for the price. So in either the both in either friendly or hostile acquisition, the difference between the acquisition price and the market price, which is actually before the acquisition, is called acquisition period. And the price is usually based upon negotiation between the acquiring firm and the target firm's manager. And another thing that's very much important is that you have to make it very clear that the final comparison that can made, and that is between the price paid on the acquisition and the accounting book value of the equity in the firm being acquired. So depending upon the how acquisition is accounted for, this difference be recorded as the goodwill on the acquiring firm's books, or not to be recorded at all. These different type of concepts are also discussed in the next slide with the help of a diagram, so that would be more clear to you in the next slide. So with the help of this diagram that is called as breaking down the acquisition price, so you can see that there are two levels. That one is the acquisition price of the target firm, that is that the price you have paid for acquiring that firm, and the second one is the market price of the target firm prior to that acquisition. That means that this at this price these the company is trading at this price, so this will be the market price of that target firm. And this one is the book value of equity of the target firm, that is actually based upon the accounting books. This would be the book value of equity or equity of the target firm. So the difference between the market price of the target firm prior to acquisition and the acquisition price of the target firm is called as acquisition premium, and the difference between acquisition price of the target firm and the book value of the equity of the target firm is called as is actually called as goodwill, and this is actually incorporated in the accounting books of the company. Now, when we talk about acquisition, so acquisition is actually a very bold decision of any organization, because in the financial perspective, when we talk about value or acquisition, it's very important first of all that you have to value the valuation of value, or you can the properly value the target firm, because when you are considering acquisition, so the value is something very much important, because the main intention of the acquirer is that they want to have the synergy and control after the acquisition of that firm. So which actually is far beyond just valuing a specific target firm, because we are measuring the synergy which is actually after the acquisition and after the transition is being done. And secondly, the control, because the control is there, as the CEO is there. There are different equity and power arrangement between different you have shareholders, you have CEOs. So either the control is appropriate, whether the control which comes after the acquisition will fulfill or will entertain the thirst for power of the CEO of the acquiring firm. So you have to consider all these things when you are considering acquiring any firm. So this important question include are that when you should consider synergy. Obviously, you are targeting the firm. So what is the appropriate time for measuring the synergy? Because when you are measuring synergy, it might be operational synergy, it might be financial synergy. So what is the appropriate time for measuring or considering the synergy, and where does the method of payment enter the process? Obviously, when you are acquiring the firm, so where you can get the payment, and how you can make the total payment and arrangement, what would be the process of that, and can synergy be valued, and if so, how? So you have to consider different types of synergies, and by considering these synergy, because all these things are based on your assumption and your obviously your financial forecasting ability and different other strategic forecasting ability. So how you are valuing this synergy, and what are the reasons for using different kinds of methods which you have utilized for measuring and valuing synergy. And second last thing is, what is the value of control, which I have discussed earlier, that when the company is acquiring firm, there are obviously there is a hidden thirst in the mind of the acquirer, because after acquiring that firm, they have more control, because they have power of the other firm as well, which they are acquiring. But it's also very important that you have to consider that how much the shareholders are there, and what is actually the power of shareholders over there, and whether you can the control which comes after the transition would be valued by the acquirer or not, and how you can estimate the value. Obviously, what the procedure you should adopt in order to estimate the value of that control. So all these issue has to be considered, has to be resolved after is resolved, because when you are taking decisions, so this decision should be taken by having certain important aspects in mind. There are various steps involved in when you are valuing an acquisition, and these are step-by-step procedures through which you can come up to the plan that what would be the motive for your acquisition and so on. Many different steps. So first step would be the establish a motive for the acquisition. As we have learned in the previous chapters, in the previous lectures, that the major motive of acquisition is to pursue the growth strategy of the organization. And in order to facilitate their growth options, they can acquire more firms. But but apart from that, when you come up with the decision of acquiring a firm, there are lots of other motives associated with that. You might be interested in the managerial skill, in the operating skills, or the technological or R&D skills, and many other activities, financial aspect and financial benefit associated with that. There are lots and lots of motive associated with your acquisition. Then, so first of all, it is very important that you should be very clear about that why you are intended to acquire that firm and what is the motive behind that. But if you are not clear about that, the later stages or latest step would be merely very confused. So first, when you have to clearly identify that what are your motives for acquiring certain firm. Secondly, that then after that you have to choose a target. Obviously, that target is actually associated with the motive you have in your mind. So by establishing clearly a motive, it would be easier for you to just select a target, a target. Then after selecting the target, you have to value that target, that whether that target is worthwhile, is actually has value, and you can achieve your motives with the help of acquiring that firm or not. So valuing the target with the acquisition motive, well done. So it's actually the after incorporating and after the deal, what would be the value of that acquisition. You have to decide all these, you have to ascertain all those things. Then after that, once you are certain that you want to target this firm because it is will achieve your these kind of objectives. After that, the fourth step would be that what type of payment mode you should you should adopt. It might be cash or stock, or if you want to have cash, so you have to make cash arrangement. And in arranging cash, you have different type of sources of finance, whether debt or equity. So you have to select the mode of finance as well. Then last thing is choosing the accounting method for merger and acquisition, purchase or pooling. That means that what method of accounting you should adopt when you are acquiring or merging with your selected target. There are basically two base choices in accounting for merger and acquisition. One is in purchase accounting. In this type of accounting, the entire value of acquisition is reflected on the acquiring firm's balance sheet, and the difference between the acquisition price, and the restated value of the asset of the target firm is shown as the goodwill for acquiring firm. The goodwill is then written off over a period of 40 years, reducing the reporting earning as in the year. The other method is the pooling. The book values of the targeting and acquiring firm are aggregated. The premium paid over market value is not shown on the acquiring firm's balance sheet. So you can select any one of both of the accounting method while you are deciding that what accounting treatment you should do with the value of the acquisition. Now, discussing the different steps involved in the acquisition acquisition process. So first of all, developing an acquisition strategy, because we are over here we are determining the motives for our acquisition. But it's very important to understand that all the firm who actually perform acquisition don't develop acquisition strategy, but the firms who have these acquisition strategy actually it is also not possible that they stick to the same strategy which they have identified, because there are certain conditions of the market, certain thing based upon that they have to modify their strategy. So there are a number of motives for acquisition, and that acquisition has to strategy has to be based on one or another of these motives. First motive is that as the company wants to pursue a growth strategy and they want to acquire firms. So first motive is that they want to acquire an undervalued firm. And when what is an undervalued firm? Actually, undervalued firms are those firms which are actually being undervalued by the financial market, and they can be targeted for acquisition by those people, those actually the strategists or the you can say the corporates that recognize their mispricing, and obviously when they acquire that business, they'll get the benefit from the difference between the value of the purchase price and the purchase price as a surplus value, and the purchase price as the surplus. So for this strategy to work, it's very important to taken into consideration three important components. The one is number one is that the capacity to find firm that trade at less than their value. So what is actually the capacity? The capacity is something which is actually the understanding, or you can say the understanding of the financial markets, or the access to the different information which are not have that in the which access to that information to which the others don't have access to that, or you have certain kinds of analytical tool which can help you to ascertain the true value of that thing, which actually that tools are not being used by the other participants of the market. So if you have all these things, that means that you have the capacity to identify that what firms in the market are underpriced, and that can give you benefit in the form of the premium which you'll get. So second one is that once you have the capacity, but it's very important that you should have the access to funds, because funds are required when you want to acquire a firm. So knowing a firm is undervalued, it actually is an advantage, but it's very important that you should also have access to certain funds which can be helpful in acquiring that firms. So access to capital depends upon the size of the acquirer. That means the company you want to acquire, if they are large firms, so obviously the large firms have more access to capital markets and internal funds in the form of retained earning and other thing. And in the case of small firms, so they actually they don't have much that kind of access to the capital funds. But other thing is also the track record of the acquirer. If the acquirer have a positive record, or they have a successful acquisitions in the previous period, so obviously the success history can be very helpful, and because they have gone through the total process of that acquisition very successfully, so it would be a success in that case also, because they have a good history and they have the experience of that. And last thing is skill and execution, that if the acquirer is in the process of acquisition, that drives the stock price up to and beyond the estimated value. There will be no value gain from the acquisition. to, for example, if you have a firm, if the value of a firm is dollar 1 million, and the current market price is 75 million. So in acquiring this firm, the acquirer will have to pay, we have to pay a premium. If that premium exceeds 33% of the market price, the price exceeds the estimated value, and the acquisition will not create a value for acquirer. So it's very important that you have to, the total transaction should give you actually benefit, or the actual price you occur would be lesser than the actually estimated value you want to determine for that firm. So while the strategy of buying under the firm has a great deal of intuitive appeal, but it is daunting, especially when acquiring publicly traded firms, because in reasonably and also in reasonably inefficient market, because if in efficient market all the information is already observed, and there is no room for more extraordinary benefit. So it's very important that you should understand that if you are in a if you want to acquire a public traded company, and in an efficient market, so that would be actually a kind of a thing which would not be better for, which would be actually create a certain daunting effect. But the this benefit, this thing can be, or the benefit can be attained in the markets where the market is less efficient, and you are acquiring a private business. So in this case, this strategy would be helpful. The other motive behind acquisition might be diversification, and as we know that diversification is a concept in which we are trying to reduce risk or diversify the total risk, which and this is actually a motive be behind the acquisition, is that the manager might think that in order to stabilize their earning and reducing their risk, diversification would be a better option. So by acquiring other firms, or other firms, or buying other firms, or merge with other firms, the manager can think that they can decrease their overall risk, and also the risk of earning volatility, and increase the potential value of the firm. But we all know that as a business students, that the diversification might decrease risk and reduce earning volatility, but it's important that whether we should achieve more benefit by trading into the stocks, or acquiring acquiring other firms in the same in different industries. So if we compare both type of both our type of transaction, so in diversification in public traded firms are more cheaper as compared to investment into other firms. So because there are two major aspects, because firstly, when we have a private firm, and we are investing all our wealth in that business. So because in this case all my earnings are at risk, because I have if I fail, I will be the only one who is bearing the whole risk. So in order to diversify risk, I can be diversify my business, and I will go for diversification, because the whole risk would be reduced and diversified. So if we look into different Asian businesses, so that's the major reason that majority of Asian business have diversified, and majority of them have become a conglomerate. But the second case, or it can be said that it's a weaker case, that in the closely held firm whose incumbent manager may have the bulk of their wealth invested in the firm, By diversification through acquisition, they can reduce their exposure to total risk through other investor, though other investor who presumably are more diversified may not share their enthusiasm. So that these are the major two reasons in which we can say that the companies go for diversification, and they can, by acquiring other firm, they can pursue the strategy of acquisition. And the third motive, and it is actually very important motive, is that in order to create operational or financial synergy, the companies are actually involved in activities of acquisition and mergers. So, what is synergy? Actually, when we talk about synergy, it's actually a potential additional value from combining two firms, and it's probably the most widely used and misused rationale for merger and acquisition. So there are, first of all, we will discuss how we can and how can create operational synergy, and what are the important sources of operating synergies. So there are different sources of operating synergy, and operating synergies are those synergies that allow the firm to boost their operating income, increase their growth, or both. We can categorize operating synergy into basically four types. First one is economies of scale, and we already know that economies of scale is actually a concept in which the per unit cost would be decreased because because the number of production units would be increased. It may rise, the economies of scale may arise from the merger, allowing the combined firm to become more cost efficient and profitable. Second is greater prices power from reduced competition, because there is a higher market share as you have acquired other firms. So now there will be a combined power market power of both the firms, and your market share also increase, which result in higher margin and operating incomes. And a third one is the combination of different financial strength, as would be the case when a firm with stronger marketing skills acquires a firm with good product lines. That means that you are actually a firm which have a very good products, and you have a product line is very good, or you have a very good marketing skills. So you can acquire a firm which have a very good product line, or if you have a good product line, you can acquire a firm with good marketing skills. So both these become important for you, and by combining both of these things, you can achieve greater efficiencies in the market. Then for fourth one is higher growth in new or existing market, because arising from the combination of the two firm, this will be the case when a consumer products firm acquires an emerging market firms with an established distribution network and brand name recognition, and uses these strength to increase the sales of its products. So operating synergy can affect margins, growth, and through these the value of the firm involved in merger and acquisition. So obviously by operating synergies, the company can achieve higher income, higher growth in its income and profits. So that will definitely benefit the company. So not only the companies want to pursue their motive of operating synergy, they can also pursue for financial synergy, where their main aim is in order to achieve financial synergy by adopting the strategy of acquisition or merger. So how we can achieve financial synergy, and what are the sources of financial synergy, and what would be the outcome of financial synergy, is that with the help of financial synergy, the company can increase their cash flow, or actually decrease their cost of capital. So what are the sources of financial synergy? The first one is the combination of firm with excess cash or cash slack. and actually limited project opportunities, and a firm with high return projects and limited cash can lead a payoff in terms of higher value for the combined firm. The increase in value comes from projects that were taken with excess cash that otherwise would not have been taken. This synergy is likely to show up most often when large firm acquires small firm, or when publicly traded firms acquire private business. So in these cases, they would be a benefit from financial synergy. Second is debt capacity can increase because now you are not one firm, you are actually two firm, and two firm combine their earnings and cash flows, and they would become more stable and more predictable, and they have a market strength and power in the market. So this in turn allows them to borrow more than they would have as individual entities, which creates a tax benefit for the combined firm. This tax benefit can take the form of either higher cash flows or lower cost of capital for the combined entity. So the last thing is your tax benefit, as it can arise either from the acquisition taking advantage of tax laws, or from the use of net operating losses to shelter income, because it might be possible that you are acquiring a firm which has unstable cash flows, and you are actually a firm with a very stable cash flow. So you can take the losses of that operating losses of that company to shelter your income. Thus a profitable firm that acquires a money losing firm may be able to use the net operating losses of the later to reduce in tax burden. Alternatively, a firm that is able to increase its depreciation charges after an acquisition will save in taxes and increase its value, because as we know that tax depreciation is another aspect in which help us to decrease our tax burden. So the company can also utilize this depreciation expense. Clearly, there is a potential for synergy in many mergers. The most important issues are whether that synergies can be valued, and if so, how to value it. And you have to measure that value and identify that whether the company is in a can be or is in a position to achieve those synergy or not, or whether these synergies are real, or these are only optimistic approach of the managers.